The big concern right now is the fiscal cliff and the effects on your investments. So let's begin with what is the fiscal cliff. It incorporates two things. First of all, mandatory budget cuts of about $109 billion, and secondly, tax increases of about $474 billion. Those tax increases, believe it or not, the Bush-era tax cuts are a small portion of that. You have a rise in the income tax, the capital gains tax, the dividends tax, and a big portion of it is the rise in payroll tax as well as the alternative minimum tax coming back and affecting many, many Americans. So let's put our government spending in perspective. On the left-hand side of the sheet, you see that currently our government is spending about $3.6 trillion. They're only bringing in about $2.4 trillion of tax revenue, which leaves a deficit of $1.12 trillion. That $1.1 trillion is added to our existing debt, which brings us up to a total debt of about $16.3 trillion. Let's put this in perspective on household numbers. Imagine that you make $24,000 per year, but yet you and your family spend $36,000 per year, and you borrow the other $12,000 of spending on your credit card. The problem is your credit card already has a balance of $163,000, and every year you go back to that credit card company and ask them to raise your credit limit. That's what our government is doing. Let's put into perspective these $109 billion spending cuts. It seems like that it gets a lot of press that it's catastrophic. It's only about 3% of the overall federal spending. And secondly, another way to think about it is only 0.7% of GDP. Pretty minor cutbacks. Going back to our household example, it means that you're only cutting spending $1,000 per year or $1,100 per year. Remember, we're already out spending $36,000 versus $24,000 coming in. Let's put tax rates in perspective. There's also a fear that the rising tax rate or higher tax rate environment is the doom for equities. Well, believe it or not, from the end of '86 through the end of '96, it's roughly a 10-year period. Notice that tax rates for capital gains were at 28%. Dividends was ranging between 29 and 39.6%. But during that 10-year period, the the S&P 500 increased 15% per year, had excellent economic growth, and also excellent returns in the equity markets. Why did the tax rates not have a dramatic negative impact? Well, the reason was government spending and what was going on there far outweighed where taxes were. Notice here on our graph, the red line shows a government spending and the blue line shows the Dow Jones Industrial. When the red line trend is going up, meaning increasing in government spending, notice that the equity markets were flat. When the government started to spend more and it started to rise, or I should say it started to spend less and started to go down, then we saw the Dow Jones and the equity markets increase and increase substantially. And then when that trend reversed in the early 2000s, when government spending started to rise again, we saw a fall off in terms of the returns from equities. So what are four things to leave with? Number one is, it's not a doomsday. We're still going to survive. Spending cuts would actually be helpful to the economy. Lower government spending means higher economic growth. Number two is tax rates definitely matter, but cutting in government spending matters more. Third, stocks have never been this cheap. Look at a previous video that we did to look at some of the assertions of how cheap and undervalued stocks are. This is one of those greatest times in the last 40 or 50 years for owning equities. And last but not least, 12 to 1. What do we mean by that? For every one person in the US or one person in Europe facing austerity, there are 12 people in an emerging economy, Argentina, Brazil, Indonesia, India, or China, that are rising into a middle class. They want cell phones, they want computers, they want cars, they want energy, they want food, they want products and services from the equities that you own. That is a great long-term reason for owning equities. Remember, stay centered on your mood, stay centered with your strategic objectives with your investments.